with Olivier Piani. He's the chairman and CEO of Allianz Real Estate. Now, these folks, it's an insurance company. They've got about $20 billion in assets to play around with in the real estate market. But what's interesting is they're looking to almost double or nearly double the amount they've got invested in real estate over the next couple of years. What's interesting is the market that they're really looking to increase their allocation is the United States. In fact, they're looking to increase it to 15% from about 2% today. So listen up to what Olivier had to say.
Why? Because if you're in the Eurozone and you say, I believe in diversification and other bigger markets in which I might have or not have a big insurance business. So in the US, you have to separate what is linked at the US insurance business and what is linked at the European investors. But when you look at the world and you say, where is the other big market apart from Europe? It is the US. So it's not, you don't have to be rocket scientists to know this and to learn about this. When I joined, they just had done one deal in the US. Allianz had done one deal in the US, which is to buy 25% of 1301 Avenue of the Americas here with Paramount. This was a gutsy deal because this was done in August of 2008. So if you remember back in time.
Remember it well.
And it's an interesting thing because, you know, it's a gutsy deal and all this, and in reality, that asset probably has declined in value after August of 2008, is now back up and further up, and will go up and do extremely well as the US recovers and all this. So if you're an insurance company, and if you buy the right type of asset at the right moment with the right partners, you don't care what happens over the next 2 or 3 years.
It's that long-term perspective.
It's a long-term perspective to prove you right, and to be right, and that's exactly what we're looking for.
In the United States, are you looking at any of the distressed areas? And I'm thinking about, you know, whether it's California, Florida, Arizona, or any of those markets showing up on your interest list?
The only way we're not a distressed buyer ourselves.
No, I know.
Ourselves, we are so the way we would buy into distressed situations is through funds or through partners. So yes, do we talk to everyone who is raising money, who has money, who's put together pockets of money and to do that? Yes, we do that. We do that. It will always be a very small portion of what we're here to do.
So what are you finding in the United States that you think is interesting? Without revealing all your secrets.
Well, I have to make sure.
Maybe a little bit.
Yes, I have to make sure I ask Jamie what I can talk about or not talk about here.
Don't look.
No,
but generally speaking.
Generally speaking, we've done this asset in New York. We've done then a subsequently deal in Boston where we bought with half of 1 Beacon Street. So we've done 2 major assets. We put money into a few funds and all this. And we're looking at also different ideas today also here. One of them is the multifamily field. Contrary to what's happening in Europe, where we're selling our residential assets in France and in Germany, we think it's an interesting potential market here. There is more demand linked to partially to the financial crisis and the people leaving their homes and all this.
And you think that change, that switch,
I think that
people maybe not buying as much but renting more, you think that's here to stay?
I think that's here to stay, and I think that the yields at which you can look at some of those deals make sense, again, in our logic and the way we look at things.
And you guys don't take on debt.
No, I know it's difficult to understand, but I'll try to explain it in
this highly leveraged world. It's
highly leveraged world, and where everyone or most of the people who do real estate do it with debt. So to have someone who says, I want to buy real estate without debt, I'll say 3 things to try to explain why we're like this. The first one is that when we buy a bond, we don't leverage it. We don't use leverage or a stock. We don't do this. So why do it for real estate? It's just another of the assets. So that's one of the reasons. And then the other 2 are linked to why do people use leverage? They use leverage because they don't have enough cash to buy what they want to buy, so they go and borrow it. Well, we always have enough cash to buy what we want to do it because we're an insurance company. They have a liquid balance sheet. And 3, leverage is used to increase return on equity. And increase return on equity, I'm not saying doesn't exist in our goals and targets, but it's really very at the bottom of the list.
Well, Olivier also went on to say, I asked him kind of about what was one of the most interesting markets, Matt, that's out there. And he said one of the more interesting ones is Los Angeles, when he looks at the United States. And they've actually been making some investments in there. But a lot of their investments around the globe play into the retail space. That's some of what they're looking for. And what he did say, too, is, you know, the crisis that we had, he said it wasn't a real estate crisis. It was a leverage crisis. And he kept kind of stressing that to me. And they obviously see opportunities. They are looking to push much more aggressively into the real estate markets.